Just on Sonic, yeah, we had flag going into the result that Sonic was really turning the corner in the pandemic, really adjusting it from over-earning on unprecedented COVID testing inflated highs. But there was certainly risk, especially with the first half, second half skew. They were shooting to 42.58. Pre-COVID, it was 46.54. Just really, that difference is really given the time required to right-size that cost space. This is a very high fixed cost business. And second half, phasing of profit enhancement initiatives and recent acquisitions. We were targeting a first half EBITDA expected to be down more than 18% and margins contracting by more than 4 points. I mean, obviously not a good look. Well, the first half result was a bit softer and mixed. EBITDA was down 20%. The margins contracted by 7 points, really due to not only the lingering COVID-19 testing related costs, but they seem to conspire with increasing costs from associated costs with equipment and personnel. This is from at least 5 acquisitions the company has done in the last 7 months. Now, this is unparalleled in Sonic's history. That really kept OPEX elevated. It put pressure on margins. And then you threw into the mix, you had elevated D&A and interest and tax, also associated with the acquisitions, as well as higher base rates. NPAT was squeezed. It was down 47%. Now, we in the market, we were looking for something closer to 36% decline. So obviously this was a bit disappointing. But that said, it appears it's a bit of a balancing act right now for Sonic. They're effectively lever and deliver margin accretion. And it's really trying to right-size the cost base off of, as I said, COVID testing highs, while at the same time trying to layer in multiple acquisitions, like I said, unprecedented in its history, the amount that they've done, that require more capital. Now, management, they seem confident that they can do this. They reiterated their EBITDA guidance, calling for a 1.7 to 1.8 bill. That's growth of flat to up to 5%. Now, they are targeting the lower end of that range, but that was where consensus was sitting prior to the first half print anyway. Now, we were a little bit optimistic, a few points ahead of that. But given the bottom line miss and the requirement for now a bigger than expected second half turnaround, even to hit the bottom end of guidance, that's earnings of about 20%, the market appears has lost somewhat of confidence that the company can actually do this. But we're keeping the faith, along with a little bit of trust in management to execute, believing that the second half turnaround is in the cards based on a couple of things. Just quickly, first, base business, kicking goals. This is everything excluding COVID-based testing, solid growth up 15%, second half about 2%, organically, 14% on pre-COVID levels. And I did a back of the envelope calculation. This company has layered in over more than $3 billion in base business revenue over the last 5 years. That's obviously through COVID. That's a 10% annual growth rate. Now, Sonic obviously is replacing COVID-related testing with this strong base business, and we expect that to continue into the future. Second point, even with normal seasonality, I get 95% of the way there to their guidance. I'll throw in some numerous other drivers. The strong growth from the recent acquisitions, that's about $500 million. That's about $100 million in EBITDA, when it's in full train. It's a 6% uplift to earnings. You have procurement benefits, rationalization, digitization of pathology. We believe they can get the extra 5%. And last, I would say the balance sheet's fantastic shape. Thank you, COVID. Gearing net debt to EBITDA 1.6 times. That's below the covenants of 3.5. 1.5 billion of headroom to keep the company quite acquisitive. This is a scale business after all here. So bottom line, nothing has changed our view. We kept our ad rating on the shares. We just don't see any structural problems or major cause for concern. Sonic, great defensive business, top and bottom line, ample liquidity for capital management and M&A to keep the growth alive. It really makes no sense to us that the shares are trading at really around pre-COVID levels for arguably a much stronger business, and at a 20% discount to EBITDA, roughly 10. Their long-term average is around 10 times. They're trading at 8. So that said, I've always said Sonic, it's a trading stock. Under 30, I'm a buyer. 35, 36, I'm letting some go. At these levels, I'm a long-term buyer. However, given the weak print out of the US overnight and some likely downgrades today, just waiting to see where things settle before jumping in.